You've probably heard people talk about making money while you sleep. And most of the time, it sounds like complete BS or something only the wealthy can pull off. But take a look at this notification. That's $10.50 that hit an account this morning, not from selling anything, not from working, but simply from owning a small piece of a company called Verizon. This is what's called a dividend. And over the next 8 minutes, I'm going to walk you through exactly how to build your first income stream using this same strategy, even if you're starting with just $100 in your pocket. No day trading, no staring at charts, no gambling. Just steady, proven wealth building that's worked for decades. Let's break it down. Quick note, the information in this video is for educational purposes only, not financial advice. Data is current as of January 2026. Always do your own research and consider speaking with a qualified financial advisor before making investment decisions. Before you invest a single dollar, you need to understand why dividend investing works. It's not just about the cash hitting your account today. It's about something called the compound growth effect that most investors completely miss. Here's how it actually works in the real world. Let's say you buy a stock today that pays you $5 a year in dividends. Now, if you take that $5 and use it to buy more shares of that same company, next year those additional shares start paying you too. So instead of earning $5, you're now earning $5.25. The year after that, it's $5.50, then $5.75. I know what you're thinking. That doesn't sound like much, but here's what most people miss. Over 10 years, that original $100 could be generating $15 to $20 a year. Over 20 years, it could be $40 to $60 annually, and you never added another penny after that first $100. That's the power of compound growth, and it's the secret engine behind every serious investor's portfolio. Bottom line is this: it's not fast, but it is relentless. And once you understand this principle, everything else makes sense. Step 1 is straightforward. You need a brokerage account. Think of this as your gateway into the stock market, where you'll actually buy and hold your investments. Now, I'm not going to tell you which broker is the best, because that depends on where you live and which features matter most to you. But here's what you should look for. First, 0 commissions. You should not be paying a fee every time you buy or sell a stock. That was the old way, and it eats into your returns. Most major brokers eliminated these fees years ago, so if someone's charging you, walk away. Second, and this is crucial for us, starting with smaller amounts, fractional shares. This feature lets you buy a slice of a stock even if you can't afford a full share. So if a stock costs $300, but you only have $50 to invest, fractional shares let you put that $50 to work immediately, instead of waiting months to save up for one full share. This is what democratized investing for regular people. 20 years ago, you needed thousands to build a portfolio. Today, you can start with pocket change. All right, here's where beginners make their first big mistake. You're going to start looking at stocks, and you're going to see some company paying a massive 12% or 15% dividend yield, and your brain is going to say, jackpot. Do not fall for this trap. When a dividend yield gets that high, it's usually a warning sign, not a celebration. It often means the company's stock price has been falling, which mathematically pushes the yield up, but the business underneath is struggling. That's not a steady income. That's a house built on sand. At Steady Stream Investing, we look for 2 things: value and consistency. We want boring companies, and I mean that as the highest compliment. We want companies that make products or provide services people need every single day, regardless of what's happening in the economy. Let me show you a real example. Kimberly-Clark, ticker symbol KMB. They make Kleenex tissues and Huggies diapers. People buy these things when the economy is booming, and people buy these things when the economy is in a recession. The demand is stable, which means the business is stable. According to publicly available dividend data, Kimberly-Clark has increased its dividend for 54 consecutive years. That means they've paid shareholders more money every single year through wars, recessions, market crashes, and pandemics. That track record qualifies them as a Dividend King. Companies with 50 or more years of consecutive dividend increases. You might also hear the term Dividend Aristocrat. Those are companies with at least 25 consecutive years of increases. Both are solid, but the Kings have that extra layer of proven resilience. When you invest in companies like this, you're not gambling on the next hot stock. You're partnering with a proven business that's been rewarding shareholders for decades. Another solid example is Verizon, ticker VZ. According to their recent dividend data, they're currently yielding around 6.8% as of January 2026, with 22 consecutive years of dividend growth. It's not quite king status yet, but the yield is attractive and the business is essential. People aren't giving up their cell phones anytime soon. First, open your brokerage app and use the search function at the top. Type in the ticker symbol VZ for Verizon and select it from the results. Now tap Trade or Buy. Depending on your broker, the button might say something slightly different, but you're looking for the purchase option. Here's the key part. Instead of selecting shares, select dollars or amount in dollars. This is where that fractional share feature comes in. Type in 50. That's how much money you want to invest right now. The app shows you a preview. It tells you you're buying approximately 1.23 shares based on the current price. Everything looks good. Review the order one more time, then swipe to confirm and submit. And just like that, you now own a piece of Verizon. The next time they distribute quarterly dividends to shareholders, you'll receive your proportional share based on how much stock you own. That money goes straight into your brokerage account, and you can either withdraw it or, better yet, use it to buy more shares and keep that snowball rolling. Let's be real for a second. One $50 investment isn't going to make you rich. That $10.50 dividend we showed at the start came from owning shares across multiple companies built up over time. But remember what we talked about with that snowball effect? Your goal right now isn't to retire tomorrow. Your goal is to prove the system works for you personally. Set a small, achievable target first. Try to earn enough monthly dividends to cover your Netflix subscription. Once you hit that milestone, aim for your phone bill, then maybe your internet. You're building income streams one brick at a time. If you can invest $50 a month consistently, that's skipping 2 dinners out or 1 less streaming service. That compounds into something real over 5, 10, or 20 years. The investors who win at this aren't the smartest or the luckiest. They're the ones who stay steady and keep showing up month after month. If you want to see exactly which dividend stocks are worth watching right now and why, make sure you're subscribed to Steady Stream Investing and hit that notification bell. We break down real companies with real numbers every single week. And drop a comment below. What's your first passive income goal? Are you shooting for $10 a month, $50, $100? I'd love to hear where you're starting from. Thanks for watching. Remember, slow and steady wins the wealth race.